Welcome. Today we're diving into the world of financial spread bidding, a popular way for UK investors to speculate on the price movements of stocks, indices, currencies, and more without actually owning the underlying assets. Unlike traditional investing, spread bidding lets you bet on whether prices will rise or fall. The key term here is the spread, which is simply the difference between the buy and sell prices quoted by a spread bidding firm. Instead of purchasing shares, you're wagering on the direction of price movement. If you're right, your profit is calculated by multiplying the price movement by your stake per point. But if the market moves against you, losses are calculated the same way. This approach offers flexibility and access to a wide range of markets, but it's important to understand both the mechanics and the risks before getting started. Spread bidding comes with several attractive benefits, especially for beginners. In the UK, profits are generally exempt from capital gains tax and stamp duty, making it a tax-efficient option. Leverage is another advantage, allowing you to control larger positions with a relatively small deposit. Plus, you can access diverse markets, equities, forex, commodities, indices, and even cryptocurrencies, all from a single platform. However, these benefits come with significant risks. Leverage can amplify both gains and losses, sometimes exceeding your initial deposit. Market volatility can trigger rapid losses or margin calls. And don't forget the costs. The spread is a fee you pay on every trade, and wider spreads can eat into your profits. Understanding these trade-offs is crucial before you start. If you're new to spread bidding, a step-by-step approach can make your entry smoother and safer. First, educate yourself, learn the terminology, mechanics, and risks. Many brokers offer free resources and demo accounts. Next, choose a broker regulated by the Financial Conduct Authority (FCA) for legal protection and transparency. Once you've selected a broker, open an account by completing the necessary verification steps. Practice with a demo account to get comfortable with the platform and test your strategies without risking real money. Before trading live, develop a solid trading plan that defines your goals, risk tolerance, and exit strategies. Finally, start small, use modest stakes to manage risk and build experience gradually. This careful approach helps you avoid common pitfalls and sets a strong foundation for your trading journey. To succeed in spread bidding, it's important to adopt proven strategies and robust risk management techniques. Beginners often start with trend following, trading in the direction of prevailing market trends to capture sustained moves. Range trading is another approach, where you bet on prices bouncing between established support and resistance levels in sideways markets. Some also try news trading, speculating on market reactions to economic releases or major announcements. No matter your strategy, risk management is key. Always set stop-loss orders to limit potential losses and use position sizing to avoid risking too much on a single trade. Diversify your bets across different markets and review your strategies regularly to adapt as you gain experience. These habits help protect your capital and support long-term success. The UK's Financial Conduct Authority (FCA) plays a vital role in regulating spread bidding firms, ensuring client funds are protected and that firms operate transparently. FCA rules require client money to be held in segregated accounts, set leverage limits, and mandate clear risk warnings. Choosing an FCA-regulated broker helps mitigate counterparty risks and ensures compliance with UK financial laws. In summary, financial spread bidding offers flexibility and tax efficiency, but it's not without significant risks. Prioritize education, practice, and risk management. With patience and discipline, spread bidding can become a valuable addition to your investment toolkit. Always stay informed and trade responsibly.